you want lower rates, but if lower rates happen, people can use that buying power to bid up home prices. How do we break the cycle?
Well, that's what's especially difficult for first-time buyers, too, because they don't have any equity to trade in. Although even existing buyers, they have their own challenges because you're going to trade a 3 or 4% mortgage rate for a 6 or 7. That's not a great trade. So that's helping to keep inventory low. It's helping to keep prices high. It's kind of this vicious cycle.
What exactly does the spring market look like to you? I understand that, you're not a housing-specific analyst, but there are signs out there that the spring season may not just be that robust because the inventory issues still remain. What does it mean for buying power and prices?
Inventory is an issue, but we are starting to see glimmers of hope on the rate front. For example, Diana mentioned rates briefly crossed 8% back in October. Now the national average is 6.93. Still high relative to the past 10 years or so, but that's going to save you $222 a month on your $300,000 loan. That's starting to make a difference. The strong job market is helpful, too. Some people are saying, you know what? We're just going to buy because we're secure in our jobs. We're sick of paying higher rent prices. There are people coming in off the sidelines, I would say.
Let's key on that positivity. We had mentioned before this idea that the consumer may be showing signs of stress. There are anecdotal pieces of evidence and maybe even some harder pieces out there, but still, generally speaking, it's good. What exactly is good for the consumer right now? Confidence is on the rise, right? Mm-hmm. And we do see people have at least keeping their buying power in some ways. Is that all there is, or is there more to that picture?
Wage growth starting to outpace inflation, that's a big deal.
So real wage growth.
Yes, hopefully we see more of that. The strong job market is a big underpinning here. It is a very K-shaped economy. We do have this element of the rich get richer, the poor get poorer. We see that with something like credit cards, where half of credit card holders pay in full, and they get cash back, and they get travel rewards and all these benefits. The other half, they're paying record high interest rates and accumulating record high balances. I think we see that divide there, really in credit cards more than anything. Car loans, too, though. It's actually prices that have been a bigger obstacle than rates. I mean, yes, rates have gone up, but the bigger hit is that a new car now costs you $50,000. And we're starting to see delinquencies at somewhat worrisome levels for credit cards and car loans, highest in about a decade. Even there, though, people are hanging in there.
Ted, a lot of experts, economists, and market watchers have been talking for months, if not over a year now at this point, about the tailwinds from COVID subsiding, the stimmy checks and all of those things starting to wear off, people drawing on savings, using credit cards more. Is that an accurate way to describe the health of the U.S. consumer right now? And if it is or isn't, what's the main thing you would key on?
I think it's accurate. What I think is interesting is, remember last year there was all this talk about we shifted our spending. So it was less goods and it was more services. We were traveling, we were going to concerts and going out to eat. I feel like we've started to see a pullback there. Some of the airlines, most notably Delta, was kind of downbeat about future bookings and their recent earnings. Maybe this 2 years of pent-up demand is starting to wane. But then again, goods had a bit of a comeback during the holiday season. So that's where I say consumers aren't feeling great about things, but the actual data, I think, is more positive than sentiment. So I do think people are hanging in there because the job market is strong.